Hello, welcome to Money Matters TV. I'm Mike Dever, founder and CEO of Brandywine Asset Management, and my two co-hosts today are Jeff Watkinson of Watkinson Capital Partners and Eric Parnell of Great Valley Advisory Group. Hello, Eric and Jeff. How you doing today?
Doing well, Mike. Good to see you today. Good to see you, Jeff.
Good to see you, Eric. Good to see you, Mike. Thank you.
Yeah, thanks. So we had, I think, earlier in the summer, we all three got together and we got to talk a little bit about markets, some economy issues and things that were going on there. It continues to be an interesting time. Right now, we see, where we're at, we're making new highs in the stock market weekly, if not daily. And there seems to be a lot of talk of bubble, yet nobody's seems to care if there's a talk of bubble. They just keep buying and pushing things up. Do you see any signs that we're like we were in 1999? This is a bubble, or what's your sense of that? Let's start with you, Eric.
Yeah, no, it's interesting because there are correlations to what we saw in the late 1990s and early 2000s with the tech bubble, but there are some distinct differences. And the first is that, so many of these companies that are just continuing to the upside, they're in large part profitable nowadays. Now, are the valuations associated with these companies sky high? Absolutely. But these are sustainable business models and companies that are making money in the AI wave, much like the dot-com bubble and the internet wave we saw 25 years ago. They're making money, which is a good thing. But the fact of the matter is that there are signs of speculative excess. We do have the S&P 500 that's trading at new all-time highs. Valuations are rich. But one of the things that I always like to say is that, valuations don't really matter until they do. And one of the things that can cause valuations to not matter is the abundance of liquidity that continues to come into the marketplace. And where is that liquidity coming from lately? Well, the Federal Reserve just cut interest rates here in September, and they're expected to continue to cut interest rates in October and December. That's added liquidity that can help support higher stock prices, even if valuations seem stretched. One other thing to add, if you take a look at the precious metals market recently, gold and silver, that's another sign that there is no shortage of liquidity in today's market.
Yeah, you're seeing gold making moves. Like, I got into the industry late 70s, early 80s. I'm going to date myself on that, but I got in. My first trade was buying silver and gold options. I just saw stuff happening, bubbling then, and got interested. And we're seeing those kind of moves today. Where you're getting that doubling in prices practically. In a very short period of time. I mean, yeah, clearly a lot of liquidity. Now, I do have a question on, and I'm going to get to Jeff in a second on those liquidity stuff too, but I do have a question on the profitability, because we did have a lot of unprofitable companies, certainly in the 90s with the dot-com boom, but you did have some of the big boys like a Cisco that were making a lot of money. And today you've got some big boys like Nvidia making a lot of money. Are there any corollaries there, or is it that different?
No, I think there is some corollaries there, because when you look back and you look at the survivors from the dot-com bubble, like you mentioned, Cisco, Microsoft, they were trading at extraordinarily high valuations that were justified by, oh, these are companies that are making money. Cisco Systems, the on-ramp to the internet 25 years ago. You think about companies like NVIDIA today being talked about as like, well, they're providing the semiconductors for everybody to be able to access these different AI functions. Well, valuation may not matter until it suddenly does. And for a stock like Cisco Systems back in 2000, it reached an all-time high and became the largest company by market cap in early 2000, just like NVIDIA is the largest company by market cap on and off here nowadays. But it took Cisco Systems 24 years to be able to return to the same stock price on a dividend-adjusted basis from the peak that it first reached in 2000. So you can have excess valuations for a while, and you can have companies that are going to survive. But there will become a point when those valuations matter. And when they do, it can be a long road. Microsoft was another one, took over a decade for it to get back to its 2000 highs. So it's something that investors need to keep in the back of their mind. The music's playing right now in the AI space, but at some point the music's going to stop, and it can be a long road ahead after that.
Well, speaking of music stopping, I'm going to go to a viewer question we have here for you, Eric. It's from Grace Miller in Philadelphia. How do you see poor employment numbers affecting the market?
No, that's a great question, because there's a lot of talk out there right now about, the potential for the economy slowing. We've seen weakness in the job market. It's not necessarily that companies are laying off right now, it's that companies aren't hiring, which raises concerns to say, could we see an economic recession associated with this if people are having trouble finding jobs? The good news on this front is that overall the economy remains strong and the economic outlook remains strong despite some of the weakness that we see in the job market. An added plus, this could actually be good for the market that we're seeing weakness in the jobs and on jobs front right now, because it means that the Federal Reserve will be more inclined to lower interest rates. If the Fed's lowering interest rates, that means added liquidity into the marketplace. It's good for stock prices. It's good for bond prices. It's even good for precious metals prices like we've seen recently. But there's one caveat to that we need to watch out for. I keep talking about liquidity in the marketplace, which basically means, effectively the money that's in the marketplace in order to buy and sell securities. There's an abundance of it right now. If you get so much liquidity and the economy is running strong, you can end up with an inflation problem. We saw that peek its head out in 2022, and the market didn't like that at all. So that's going to be the big thing that we need to watch in the months ahead is, if the Fed's lowering interest rates, what does that mean for inflation? And do we see an inflation outbreak?
That's great. And we're going to come back right after a break, and we're going to ask Jeff about that and what he's seen in the muni bond market related to that. In the meantime, if you want to send in a question to Money Matters TV, here's how you can do it.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Okay, welcome back. Thank you. Okay, well, I'm going to ask Jeff this question. Jeff, what are you seeing at Watkinson Capital Advisors related to this liquidity flowing into the markets? Is it causing trouble, or do you see opportunities in the muni bond market from this?
Thanks, Mike. Our advantage strategy in the municipal bond marketplace is really dictated by the shape of the yield curve. And we look at the yield curve and where is the value? Where is the excess yield? And
Jeff, just for a second, I know most people they're watching this show are pretty knowledgeable, but just a kind of quick explanation. The yield curve is what's the difference in the rates that are on bonds expiring in the short term versus the long term.
Exactly.
And we've gone into a pretty it's steepened up over the last couple of years from being inverted, where short-term rates used to be higher and long-term rates were lower. It's kind of flipped, and you got longer term rates that are higher now.
Exactly. It was inverted. So, there's 30 years going out, and what it does, a AAA municipal bond, the highest rated bond, what does it yield? And that, goes out, it starts at 0 to 1 and goes up out to 30 years. And you're right, it was inverted, which meant there were higher interest rates in the short portion of the curve out to about 7 years. And then there was a belly in the curve. So this happened a year and a half, 2 years ago. There were higher yields out to 7 years. And then, so there was a big hump, and then it came down. There was a soft belly between 7 and 20, 25 years. And then it got steep again, more yield out 25 years of maturity. So, and then the yield curve So we were doing a barbell. We were a barbell strategy, buying
Short
maturities
and
less
long.
than 7 years and long, avoiding the middle, like a 10-year bond. So, for the last 2 years, up until the end of August, the yield curve has been very steep. So you're still finding bonds at a 3% yield, less than 5 years, and then out further on the curve, out 25, 30 years, these are bonds maturing in 2050, 2055, 2060, 2065. We were seeing tremendous yield pickup. And when the Fed announced, it appeared by August, by the end of August, heading into the Fed decision cycle in September, that we were going to get a cut and there was going to be more liquidity. And it was a phenomenal thing. Here's a phenomenal stat for you, and this is from July of 2025. What you have to remember, municipal bonds are mostly owned by individual investors, either directly owning them or indirectly owning them through municipal bond mutual funds or municipal bond ETFs.
And that's because of the tax benefits of holding them, where obviously an endowment or some other institution that doesn't get the tax benefit, they don't have a reason to buy a muni bond as much.
Exactly. So I'm setting the table for this stat, and it's a very unique asset class because 70% of it is owned by individual investors. In July 2025, into bond funds and bond ETFs, 89% of the flows, the net inflows, were to short term, which is a year or less, or intermediate bonds, 2 years to 7 years of maturity. Let's just round it up to 90% of the money was going there. And the value, where we were seeing 5% nominal yields in the state of California, in the state of Pennsylvania, which equate to a 9 or 10% tax equivalent yield, were presenting themselves weekly in new issuance municipal bonds. And so cut right back to the end of August, beginning of September, the individual investor and their advisors realized here's the value. And since then, we've seen a tremendous inflow of capital into these longer duration bonds, these longer maturity bonds. So the yield curve was really steep, and now it's flattened out a little by about 50 basis points.
So all that buying pressure has reduced the rates on the long end and brought the flattened out the yield curve.
Exactly. Prices went up, yields went down. So real quick, I mean, the last bond that we really bought, a 5% coupon, AA Interborough School District, Delaware County, Pennsylvania, 5% coupon, 2055 maturity, 10-year call protection. We bought that bond at a 505 yield, close to a 9% tax equivalent yield for a Pennsylvania resident. That same bond today is trading at a 465 yield to that 10-year call.
Wow.
So there's been that 50 basis point shift, and that's still a tremendous equity. Eric can tell you what's the average annual return of the S&P 500.
Depends whether you're talking the last 5 years or 10 years or
years. Yeah,
the last 100 years. It might be 10% all in with going back a century and going back to the end of the financial crisis. It's probably more like 13, 14. I don't want to cut you there, but that just leads me to an anecdote. I talked to an investor earlier this week, and this is kind of getting back to the original question I had with you, Eric, on the bubbles. But she told me that all she's looking for is a 20% return. I've talked exactly, and I've talked about this before.
What was your
When,
answer?
well,
with no downside risk too,
my
right?
answer was I gave her an anecdote out of my book. I said in 1999 I had an investor who had been with me for almost 2 decades, and he was retiring. He said, "I want to take my money out," and I said, "Oh, that sounds like makes a lot of sense, Fred. What do you think you're doing then? Where are you going to put it?" He says, "I just want to put it somewhere where I get a safe 20% return." I did what you did. I broke out laughing. He was serious, honest to God. So
Wow.
his 600,000, year and a half later, he came back with 300. He didn't do anything yet. 6 months later, he came back with two and a quarter.
Wow.
I gave her that anecdote. She didn't know I was talking about her. So the people right now, I do see this
Yeah.
flagrant kind of just care, no cares kind of, attitude that's happening out there. And it's great. You get liquidity and it drives prices, but at some point value does matter. And if you end up with things that are, instead of being 23 PE, they end up 30 PE, that doesn't make them any better because they just went up a lot.
Yeah.
It just makes them more dangerous.
Yeah, just building on that point, Mike, valuations don't matter until they matter a lot. And the downside that you can get, I mean, the names that lead to the upside when the market is soaring to new all-time highs are almost always the names that lead to the downside. We saw it earlier this year in 2025. We had that correction from February 19th to April 9th, which is kind of distant memory for a lot of people now. But the stocks that really, really took the broadside of that downturn are the same high flyers that everybody's clamoring to get into now. And, to your point, investors love risk when markets are going higher. And one of the challenges, you're right, we saw it during the dot-com bubble, and we've seen it other times in the past. It's at those moments. We even saw it in 2021 to a certain extent, where the markets had such a COVID surged run. They lose sight of the potential downside, the other side of the sword that can come so quickly and so painfully.
Do you make any recommendation changes, skewing the portfolio, do anything with your clients because of that? I just want to point out that from what I've seen, right, you've got the high growth names that are out there, the Nvidias and Tesla, and it's just doing phenomenally well. And then you get into the small cap, and it's like they're not moving. And then you get into value and small cap value, and do they even know there's a bull market?
Exactly. No, that is the thing. I mean, you hear about this market concentration, and it has been so profound over the last 2 years in particular. You think back to last year, and the normally you would expect half of the stocks in the S&P 500 stocks. You would expect roughly 250 of those stocks to outperform the S&P 500. We saw, less than 40% of stocks outperform the S&P 500 last year, and it was driven by those mega cap stocks at the top of the market. And we've seen that phenomenon again play out this year. The good side to that, from a risk management perspective, is that there are still a lot of areas of the market, even within the large cap space, because Mike, you're absolutely right. You look to mid caps, they're lagging large caps. You look to small caps, and it's like bull market. What bull market? We can't find it. Right. But there are good areas of value in in many of the other sectors of the S&P 500 that haven't really participated the way that technology or communication services or certain segments of consumer discretionary have really led to this point. And, kind of seeking to maintain that balance, participating in those areas that are leading the market, but not losing sight of those areas of the market that could lead in the next phase when things cool off a bit.
Yeah, that's I saw there was an article just recently that quoted Paul Tudor Jones and saying it's that last year of a bull market where it goes into bubble that you make twice the returns that you would any other period. And so people are incented to stay in right to the end and hope they jump out before it hits the fan. Now, Jeff, do you see anything like that? Is in the muni, is there that kind of unbridled enthusiasm ever, or is it muni market? Do you ever get that kind of excitement?
We're seeing more clients who are locking in some of those gains. They realize, hey, I'm going to retire in 5 years. I can't afford a 58% peak to trough drawdown like we saw from 2007 to 2009. But really, the muni market's wild, 70% owned by individual investors. You go back to 2020 when the 10-year treasury was what, 75 basis points, 1, not even 1%, the 10-year treasury.
Right.
And you had to go out 10 years for a California municipal bond to earn 1%. And there was $2 billion a week, the weekly inflows. People could not buy bonds enough or faster. That was really the bubble in muni land. The demand for, sky high prices, paltry little yields.
How do you explain that? How do you explain that mentality that they're rushing to get in when it's clearly, historically, obviously, at levels that are almost unprecedented, as far as how low they are, how little return they're getting on it. I mean, why don't you see that now? I mean, multiples of that now, because now they actually get a return.
I would credit that to, and we can also see this in the equity markets, headline risk. People read the paper, they read the news. Oh my gosh, taxes might be going up. Oh my gosh, I better buy bonds now. That was kind of the story. That was the story we saw in 2021. We saw it 15 years ago with Meredith Whitney, who after the this is 2010, 2011, she claimed that she was credited with predicting the financial crisis. And then she came out and made this other prediction that there would be hundreds of billions in defaults in municipal bonds, investment grade municipal bonds.
Mm-hmm.
And there was $40 billion in municipal bond funds that exited in 1 month. Wow. And that created a liquidity crisis because there were no buyers. The sellers overwhelmed the buyers, and it was a tremendous buying opportunity because she was dead wrong, vindicated. But it's headline risk. I mean, we tell some of our clients who are retired, who are golfers, the biggest risk to your portfolio is rain. In your home, in your basement, in rain. You're not playing golf. You're not fishing.
That's how you want it to be. It's a beautiful way to be. It's interesting you talk about Meredith Whitney, and that was another one of my chapters in my book talking about experts, and the data showed that the experts were about in the mid 30% correct with their predictions. And it's because some of it's just hubris, some of it's because they only get picked up on the channels if they're bombastic and they have extreme views to go out there and preach. But the one example I use on that was Joe Granville, who was just minting it. He calling market turn after market turn. He did that for like a couple of years, and now all of a sudden he thinks he knows everything. He actually, the quote I have in there is, "I will never make another mistake in the stock market again." He said that, and you talk about the hubris and how, and as Mark Holbert showed in his newsletter, over the next 20 years, he was down 99%. He was the bottom performer of every newsletter writer that he'd have ever had. But it's these experts, and what I'm talking about is to point out to people watching this is, don't turn on CNBC or Fox Business News and listen to somebody spewing something and think they know more than you do, because they don't. And you don't want to be making investment decisions because somebody's loud and boisterous and sounds like they've got a good pedigree, because they don't know. The examples I gave in the book were different. The Fed chairmen, making predictions that were totally off the mark. If they can't do it, you can't do it. Try to create a stable portfolio, keep balance in it, skew it a little here and there, maybe, to what your liking is, but, don't think because you've been making money, you know how to make money and
Yeah.
skew it, dramatically. I mean, what do you
Yeah.
think, Jeff? I mean,
I remember in 2008 when the market was down big and I was in my 20s, and I made a resolution that, I mean, everything was on sale and I didn't have much capital. I didn't have any dry powder. I didn't have any reserves to speak of. And it's the need for liquidity when the markets turn.
Mhm.
And that's a lesson I've never forgotten, because everything was on sale. Not everything, but there
yeah.
were tremendous value. And I didn't have I could have really made a huge difference in my portfolio. And
Absolutely. And yeah, so Eric, do you see that with, I mean, I read constantly about Warren
Yeah.
Buffett, cash hoard, money aside, 8 quarters in a row of net sales in his portfolio. When I say, the guy on TV, maybe he doesn't know any more than you do. That's one guy that maybe does know more than you do. Not saying you personally there, Eric, but us. What do you think? I mean, should people be doing something different ever, or are they?
I think the biggest thing, and I think both Jeff, you and Mike are really hitting it right on the head, is that there's a lot of opinions out there. You'll see it on the television, you'll hear it at the cocktail parties, and it's really easy to get caught up in the vortex of the momentum and of the noise and of the emotion of everything that's driving financial markets. But the one thing that I always like to come back to is that for any investor, always do your own homework. You may hear things and they sound great, and you say, well, this is an opportunity I can't pass up. But always do your own homework to validate it for yourself, to say, does this really make sense? And that doesn't mean that you need to be an expert in finance or, certain specialized investing or a hedge fund manager or anything like that to do your own homework. More often than not, it is seeking the views of multiple perspectives to say, okay, I've heard this from one person. Let me check this out from a couple other sources to see, is what am I hearing? Is this really the truth? Because by taking that extra step and validating the things that you're hearing or challenging the things that you're hearing, it will help keep you from making the wrong step, and it will help protect you from that downside risk that is, like you talked about before. People can be right for a while until they're suddenly very wrong, and then the game is over. Protecting against that downside risk while trying to be rational and capturing that upside.
Yeah, no, I think that's well said. I think it's a good way to kind of wrap up this show. That you don't want to get caught up in the emotions of whatever it is. Try to stay balanced. Keep your portfolio balanced as well. Don't get, just because something's working well, caught up in that. The other thing is, people have a viewpoint and they seek out reinforcement of that viewpoint. And you need to be able to challenge your viewpoint. If all you're doing is clicking on the articles that say what you want to see, you're never going to learn anything new, and you're going to make mistakes. Believe me, I've done it myself. I know exactly what that's like.
Mike, I'm going to jump in real quick because I heard a
Yeah.
great quote. You need liquidity in your mind, in your
I like.
thinking.
There you go.
The ability to absorb and deploy capital of your brain power, and by looking at other opinions and doing what Eric said. Use other people as a sounding board. Ask open-ended questions. Don't lean one way or another.
Yeah.
It's
Stay
great
balanced. All right. I appreciate that, Jeff. That's a great way to end the show. Thank you all very much for watching Money Matters TV. Our next guest is going to be Joe Anderson from Saray Wealth. Thank you for watching. And until next time, thank you, and enjoy Money Matters.